Howdy, Jacob here. Today we're looking at Bio-Rad Laboratories in the life sciences tool and services industry. 8.2 billion market cap on 7.8 billion enterprise value. They manufacture and distribute life science research and clinical diagnostic products globally. Growth is not super immense, but 2.2 million to 2.7 million billion, sorry, 2.1 billion to 2.7 billion. And gross margin very flat. Operating margin is up quite a bit. So it looks like something happened post COVID that made their margins jump quite a bit. We'll see if they can hold on to that. Earnings per share negative the last 2 years. That's kind of interesting. We'll have to look at what that is. Might be a one-off expense that's making their return on invested capital negative. But before that, you were seeing pretty solid return on invested capital. We'll look at those negatives first. So this other, we see negative 5.2 billion and minus 1.2 billion. And so if you remove those, then, it looks like over here it's because it was very positive, these other non-operating incomes. So, yeah, I know a lot of people look at operating profit before it. This interest is crazy. So, yeah, let's look at the cash flow. It's gonna after the balance sheet because that's gonna be more in line with cash in, cash out. So this company has 404 million cash on hand with 1.2 billion short-term investments and 7.7 billion in long-term investments, with 1.2 billion long-term debt, zero short-term debt. So that's a very safe balance sheet. We're really not concerned about that at all. Now for cash flow, let's see if there's more consistent. So we do see this other offsetting those crazy decreases. And it's fairly consistent. If you look at the last 5 years, again, 2014, 2018, sometimes the website does this. I think this is their capital expenditures. But over here, we are looking good, where the last 5 years, you're averaging 300. I don't like that it's lower the last 2 years. Their use of cash is mostly acquisition, reinvestment, share repurchases. They issued a little bit of debt in 2022, but again, it's not a lot of debt in comparison to the cash they produce as well as the cash they have on hand. And so for a company like this, buying back shares, making acquisitions, reinvesting, probably the smartest thing for them to do. Let's just go to assumptions quick. So revenue side, I just don't think there's going to be that much revenue growth, but I do think that at the end of 7 years, they'll probably have similar growth ahead of them. For margins, I'm really leaning on this free cash flow figure, and I'll do probably a little bit of a range here. So maybe let's do 9 and 11. Maybe let's do 10 and 12. And then for share change, 1% would be about 82 million. 140 million to offset stock-based compensation. That's a lot of their free cash flow, but I think that seems reasonable to me. With how much cash they have on hand and everything, I think that should be more than fine, leaving a 50% or so of their 5-year average to just make a 3% revenue growth and then to have these types of margins. So pretty interesting stuff, but we are still 75% off the price that we're looking for, given the return that I want. So I'll just be waiting here till it gets to a more attractive price, reviewing other companies. Thank you, and have a great rest of your day.